Hello everyone. In this class, I am going to teach you an important topic in accounting, that is bank reconciliation statement, that is BRS. So what is a bank reconciliation statement? It is a document that explains the differences between the balance in your cash book and the balance in your bank statement or passbook. Means it helps to identify the differences between the balance in your cash book and the balance in your bank statement or passbook. So these differences occur due to time delays. Due to time delays or timing differences on a recording of the transactions, or errors made by the business or by the bank, or the transactions are recorded only in one of two records. So these are the reasons for the differences between in your cash book and the balance in your bank statement or passbook. Now we will see why do we need to reconcile. To ensure accuracy and detect fraud and maintain financial control in cash book and passbook. So that we need to reconcile our cash book and balance in your bank statement or passbook. Now we will see the reasons for differences in the balances. In that first one is check issued but not yet presented for payment. Means these are the differences, means these are the reasons for differences in balances, means in the cash book and bank balances. What are the reasons for the differences in the balances? In that first one is check issued but not yet presented for payment. It means what? It means check issued by the business. Check issued by the business and they record the check payment immediately in the cash book. But the bank processes it only when the payee present it for clearing. Okay, this is the meaning of first point. Now I will explain this point through one example. See here, a business issues a check of rupees 10,000 to a supplier on Jan 25 and record it in the cash book but not yet presented by the bank. See, before that, before solving a problem, I will explain about cash book and passbook. See here, in the cash book, debit side, all the receipts will come and credit side, all payments will come. Means, we have to add all the receipts and we have to deduct all the payments. And the passbook is just exactly the opposite of cash book. Here, debit all withdrawals from the bank. And credit means all deposits into the bank. Here we have to deduct all the withdrawals and we have to add all the deposits. See, this is very important in bank reconciliation statement. In cash book, all the receipts will come in debit side. We have to add and all the payments comes in the credit side and we need to deduct. And in the passbook, all the withdrawals comes in the debit side, we need to deduct, and all the deposits will come in credit side, we have to add. Okay, now we will solve the problem. See, on Jan 24, the opening balance of cash book is 50,000. But on Jan 25th, what they did? The businesses issues a check of rupees 10,000 to a supplier. It means business issues, means check issued, that comes under payment side. Means we have to deduct here. See, our balance is 50,000 and that we have issued a check of rupees 10,000 and so our net balance, that is rupees 40,000, means 50,000 minus 10,000. So our cash balance on Jan 25th is 40,000. And what we have to do in the passbook? Here they said but not yet presented by the bank. Here the supplier, he has not presented. Means Jan 24th opening balance is 50,000 and Jan 25th no entry because check is not at all presented. So the passbook balance is rupees 50,000. Now we have to make the comparisons between the cash book and passbook. Okay, see here, the balance of cash book is rupees 40,000 and the balance of passbook is rupees 50,000. It means what? Here cash book balance is decreasing, that is rupees 40,000, and passbook balance is rupees 50,000, means cash book balance is less than passbook balance. So this is the differences between the cash book and passbook, that is rupees 10,000 is the difference between the cash book and passbook. Fine. So this is the one reason, that is check issued but not yet presented for payment. Now the second situation is check deposited but not cleared. Check deposited but not cleared. So here the business, it records the check deposit, but the bank credits the amount only after the clearance. Business records the check deposit immediately, but the bank what will do, it credits the amount only after the clearance. See the example here. A check of rupees 15,000 was deposited on Jan 28th. On Jan 28th, check of rupees 50,000 was deposited. Okay, but not yet collected or cleared. Okay, first we will solve in the cash book the opening balance, that is rupees 30,000. And here we are not issuing the check, we are depositing the check. So what we have to do, it means it comes in the receipt, means debit side. So check deposited, that is rupees 15,000. Write down in the debit side, that is receipt side, because we are receiving the, means we are depositing the check of rupees 15,000. So on Jan 28th our balance is 30,000 plus debit all, means we have to add the receipt and we have to deduct the credit side, means all the payments we need to deduct. So 30,000 plus 15,000, that is rupees 45,000 is our balance on Jan 28th. Fine. Now see the passbook. On Jan 27 opening balance 30,000. Jan 28th what happened? A check of rupees 15,000 was deposited on Jan 28 but not yet collected or cleared. Means here there is no entry. On Jan 28 in the passbook there is no entry and the balance is rupees 30,000 only. But here in the question they have given, but it cleared on Jan 31st. But it cleared on Jan 31st. It means what? Check cleared. Jan 31st. Check cleared. It comes under debit or credit side. It means what? Check cleared means we have to enter the amount. It means cleared. That is deposited, means it comes in the credit side, that is rupees 15,000. Here debit all the withdrawals we need to deduct and all the deposits we need to add. So here 30,000 plus 15,000, that is rupees 45,000. Here check is deposited or cleared, that is on Jan 31st. Now we will make the comparison. See, on Jan 28, the cash balance is increasing, that is rupees 45,000. But the bank balance or the passbook balance is only rupees 30,000 because the check is not cleared. Okay, this is the comparison of cash book and passbook in the second situation. Means cash book balance is more than passbook balance, that is rupees 45,000. So the difference is rupees 15,000, but on Jan 31st the check is cleared. Okay, so this is the second situation. Now we will see the third situation, that is direct deposits by customers. Direct deposits by customers. It means what? If a customer deposits money directly into the bank account, customer deposits the money directly into the bank account, the business may not be immediately aware of it. Here, customer deposits the money directly into the bank, but the business, it may not be immediately aware of it. Here, see the example. Customer transfers rupees 20,000 directly to the business account on Feb 1st. But the business is unaware of this transaction. Business doesn't know about this transaction. But the business is unaware of this transaction. But the customer, what he did? He directly transferred the amount to the business account. So how we have to record in the cash books here? Opening balance, that is rupees 10,000. Opening balance is rupees 10,000 and customer transfers rupees 20,000 directly to the business account on Feb 1st, but the business is unaware of this transaction. Means here there is no entry. On Feb 1st, there is no entry. Why? Because they don't know. So that's why they have not entered anything in the cash book. So February 1st, their balance is 10,000 only. And in the passbook, February 1st, the opening balance is 10,000 and February 1st, the customer deposit, that is rupees 20,000. Means we have to enter in the credit side, because credit side means all the deposits will come in the credit side. We have to add all the deposits and we have to deduct all the withdrawals, that is rupees 20,000. It means, so our balance on February 1st, passbook balance, that is rupees 30,000. It means what? Bank balance is increasing compared to cash book. Compared to cash book. Bank balance is increasing compared to cash book. Here cash book balance is only rupees 10,000 because they are unaware of this transaction. So they have not entered anything on Feb 1st. Their balance is only rupees 10,000. But in the passbook, their balance is rupees 30,000. Here the bank balance is increasing. Okay. The bank statement reflects the new balance. That is rupees 20,000. But the cash book does not show the deposit. Okay, this is about the third situation, that is direct deposits by customers. Now next one is fourth one, that is bank charges not recorded in book. Bank charges not recorded in book. It means what? See, sometimes the bank deducts the charges like service fees or any check collection charges. But the business may not be aware of these charges. Bank deducts the charges, but the business may not be aware of these charges. The business comes to know when? About it only when the bank statement arrives. Only when the bank statement arrives, business comes to know about it. That is bank charges. That is not recorded in the book. Means in the cash book. But the bank already deducts the charges like service fees or any check collection charges. Okay. So here see the example now. Bank deducts rupees 500 as account maintenance charges on Jan 30th. But the business is unaware until the bank statement arrives. So in the cash book, Jan 29th opening balance is 20,000. But on Jan 30th, what happens? They deduct rupees 500. They deduct rupees 500. No entry in the cash book. Why? Because business is unaware. Business is unaware about this deduction. So the balance on Jan 20th, the cash book balance is only rupees 20,000. And in the passbook what happens? Jan 29, the opening balance is rupees 20,000. And on Jan 30th, write down Jan 30th, bank deducts It comes under which side? Jan 30th. So write down here bank charges. Bank charges how much? That is rupees 500. It comes under withdrawal, means under debit side, that is rupees 500. All the withdrawals we need to deduct, all the deposits we need to add. Here bank deducts. That is rupees 500. So bank balance, that is rupees 19,500. Bank balance is rupees 19,500. So here now we have to make the comparisons. How we have to make the comparisons? See, cash book balance is increasing, that is rupees 20,000, but passbook balance is, that is decreasing, that is rupees 19,500. So the balance as per the passbook, it will be less than the balance as per the cash book. Okay, balance as per the passbook, it will be less than, that is rupees 19,500, than the balance as per the cash book, that is rupees 20,000. Okay, this is about fourth point, that is bank charges not recorded in the book. Next one, next situation, that is interest or dividends credited by the bank. Interest or dividends credited by the bank. It means what? Here sometimes the bank, it may credit interest or dividends, but if not recorded in books, it causes a difference. Bank credit interest or dividends, but if not recorded in the cash books, it causes a difference. So for example, bank credits rupees 1,200 as interest on a saving account on Jan 31st. Bank credits. Okay. So the cash book balance is opening balance, that is rupees 25,000. And here in the cash book, there is no entry. Why? Because it is not recorded in the cash book. It is directly recorded in the passbook. So what is the passbook? How we have to record the transactions in the passbook? On Jan 31st, Jan 30th, the opening balance is rupees 25,000. And Jan 31st, bank credits rupees 1,200. Credit means deposits the interest. That is rupees 1,000. Interest or dividends, that is rupees 1,200. Means we have to add all the deposits, we need to add in the passbook, all the withdrawals we need to deduct in the passbook, that is rupees 25,000 plus 1,200, that is rupees 26,200. Now make the comparisons. See here, passbook balance is more than cash book. Passbook balance is increasing, that is rupees 26,200, and the cash book balance is rupees only 25,000. There is a difference. There is a difference of rupees 1,200. Okay, this is the fifth situation. And next one, last one, that is errors in the cash book or passbook. It means what? See, the mistakes like duplicate entries or wrong amounts or any omissions in either the business records or the bank statements. Okay, so these are errors in the cash book or passbook. For example, the accountant, he mistakenly records a check of rupees 8,500 as rupees 5,800 in the cash book. The accountant mistakenly records a check of rupees 8,500 as rupees 5,800 in the cash book. Means the actual amount is rupees 8,500, but he mistakenly recorded as rupees 5,800. Now see the cash book. On Jan 29th, opening balance is rupees 50,000. And Jan 30th, check issued. Check issued by the business. Where we have to enter? Issued means payment side, in the credit side. That is rupees 5,800. Here accountant mistakenly, see here very careful, accountant mistakenly records a check of rupees 8,500 as rupees 5,800. Means in the cash book we have to enter rupees 5,800, not the actual amount. So all the receipts we need to add in the cash book, all the credit means all the payments we need to deduct in the cash book. So 50,000 minus 5,800. Why minus? Because check issued means payment. That is rupees 44,200. Next one, in the passbook, see Jan 29th opening balance 50,000 and Jan 30th check cleared. Here we have to write down the actual amount. Because in the business the accountant made a mistake, that is rupees 5,800. But in the bank the check cleared with the amount of rupees 8,500 only. Means here where we have to enter? See here, just exactly the opposite of cash book means withdrawals in the debit side. That is rupees 8,500. All the withdrawals we need to deduct in the passbook, all the deposits we need to add in the passbook. So 50,000 minus 8,500 because cleared, check is cleared. Check issued by the business and cleared in the bank, that is rupees 8,500 means the balance is 41,500. 41,500. But in the cash book the balance is 44,200. Means here cash book balance is showing more balance. Here they have entered the wrong amount, that is rupees 5,800. But in the bank statement or in the passbook they have entered the actual amount, that is rupees 8,500. So the balance is here showing less amount, that is rupees 41,500. Okay, this is about sixth situation, that is errors in the cash book or passbook. So these examples clearly show how differences arise between the cash book and passbook and how a bank reconciliation statement helps to identify and correct them. Okay, this is about the main reasons for differences in the cash book and passbook. So this concept is very important. Here I will finish this class. If you have any doubts, please leave a comment. Thank you.